Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
You know, when you turn on the tap in your kitchen, you just expect water to flow out.
Right, exactly. You don't think about it.
Yeah, and when you hand a pharmacist a prescription, you expect the pills to just be in the bottle. You never really think about the plumbing.
No, nobody does.
But today, we are doing a deep dive into the invisible pipes of the U.S. healthcare system. We're looking at a massive company called Cardinal Health.
Yes, ticker symbol CAH.
Right. And we're going to figure out why this $200 billion middleman is quietly trying to, buy up your doctor's office.
It is a profound shift, really. I mean, we are watching a legacy logistics giant try to mutate into an entirely different kind of healthcare powerhouse.
Totally. And to map out how they're doing this, we are pulling from a really comprehensive research report by Compasscope, and we're cross-referencing that with Cardinal Health's recent Q3 2026 earnings call transcript.
Yeah, the Q3 data is fascinating.
It really is. So if you're an investment enthusiast looking to understand the real mechanics of healthcare supply chains and market dominance, this is the place to start.
Absolutely.
So let's just look at the sheer scale of their current business. I mean, we hear they distribute drugs, but what does that actually look like on the ground?
Well, think of Cardinal Health as kind of the central nervous system for medical supplies.
Okay.
They handle over $200 billion in annual U.S. drug distribution.
$200 billion. Wow.
Yeah, and they're actively supplying over 60,000 pharmacies and healthcare providers.
That's a massive footprint.
It is. And the business is essentially split into three main divisions. The undisputed giant in the room is their pharmaceutical and specialty distribution segment.
Right. So that's the core plumbing, just moving the branded and generic pills around.
Yes. But it also handles specialty distribution, which requires incredibly complex logistics.
Like what?
Think temperature-controlled oncology treatments or, specialized urology drugs. You can't just put those in a regular truck.
Oh, right, of course.
And crucially, this division houses their management services organizations.
The MSOs.
Exactly, like GI Alliance and Solaris Health. And it also includes Red Oak Sourcing, which is their generic drug procurement joint venture with CVS.
Oh, we are definitely going to dig into that CVS relationship in a minute.
It's a huge piece of the puzzle.
So what are the other two divisions?
So the second is Medical Products and Distribution, or GMPD. This is the medical surgical supply side.
Meaning like the physical tools?
Yeah, everything from basic hospital bed sheets to proprietary Cardinal Health brand consumables, so exam gloves, surgical gowns, things like that.
Okay, so Division 1 is the drugs, Division 2 is the physical supplies.
Right. And Division 3 is where the high-margin future lives. These are what they call the higher growth adjacencies.
I love that corporate jargon. Adjacency.
I know, right? But it includes their at-home solutions for home-based medical care and OptiFreight logistics.
Which is what exactly?
It's their healthcare third-party logistics platform. And there's also a really fascinating division called Nuclear and Precision Health, dealing with radioactive pharmaceuticals.
Radioactive pharmaceuticals. Okay,
Yeah.
We're coming back to that too.
Definitely.
But I want to pause on the core business for a second, because looking at those first two divisions, moving pills and delivering exam gloves, I have to be honest, it sounds incredibly commoditized.
It does seem that way from the outside.
Right. I mean, if I have enough capital, why can't I just, build some warehouses, buy a fleet of trucks, undercut Cardinal on price, and just steal those 60,000 pharmacies?
Because you wouldn't just be competing on warehouse space. You'd be competing against a financial engine that is almost impossible to replicate.
Really?
Yeah. The secret to Cardinal Health isn't the trucks. It's their negative cash conversion cycle.
A negative cash conversion cycle.
Oh.
Okay, walk me through the actual mechanic of that.
Sure. Let's say you own a pharmacy.
Okay, I own a pharmacy.
You buy a shipment of drugs from Cardinal Health on a Monday. Cardinal requires you to pay them for that shipment by, say, Friday.
Simple enough. I wire them the money.
Right. You wire the money. But here's the trick. Cardinal bought those drugs from, let's say, Pfizer. And Cardinal's contract with Pfizer says they don't have to pay for the drugs for another 30 or maybe 60 days.
Oh, I see. So for an entire month, Cardinal is just sitting on my pharmacy's cash before they have to hand it over to the manufacturer.
Precisely. Now multiply that by $200 billion a year.
That is insane.
Yeah, Cardinal Health is perpetually sitting on this massive, constantly replenishing pile of cash.
afloat.
Exactly, afloat. And they can use that to fund their own operations, buy competitors, invest in new tech, all entirely interest-free.
Wow.
They're generating billions in working capital just by being the middleman.
That is wild. It's basically a free loan from the entire U.S. healthcare system.
It really is.
Which leads perfectly into their competitive mode, I guess. Because if they have that kind of financial leverage, who are they actually fighting against?
Well, they operate within a strict, deeply entrenched oligopoly. Cardinal Health is part of the big three full-line wholesalers.
Alongside McKesson and Cencora, right?
Yes. And together, those three companies distribute over 90% of all U.S. prescription volume.
90% market share split three ways. That is a literal fortress.
It is.
And actually, the Compascope report highlighted a statistic that just blew my mind. No major U.S. retailer has changed their primary distributor in the last decade.
Not a single one. Which goes back to your earlier question about just building a warehouse to compete. You can't.
Right.
The switching cost moat is impenetrable. Cardinal Health isn't just, dropping boxes at the loading dock.
They're integrated.
Deeply. Their IT systems, inventory management, predictive ordering software, it is completely embedded into the digital nervous system of these hospital networks.
I would assume ripping that out isn't just an IT headache. It's a massive operational liability.
Oh, a huge liability.
Because if a hospital decides to switch to McKesson and the software integration hiccups for even 24 hours, you have surgeries getting canceled because a scalpel order failed or, patients missing life-saving medications.
Exactly. The risk of a service disruption is simply too high. Plus, because all three of the big three have similar massive scale, a hospital wouldn't even get meaningfully better pricing by enduring that nightmare transition.
Just gridlock.
Total gridlock.
But inside that gridlock, Cardinal has a unique weapon with Red Oak sourcing, right? That joint venture with CVS.
Yes. Red Oak is really the linchpin of their profitability.
How so?
Well, generic drugs only make up about 10% of Cardinal's total revenue.
Okay.
But they account for more than 2/3 of their gross profit.
Wait, I need to stop you there. 2/3 of their profit comes from just 10% of their revenue.
Yeah.
How is that math even possible?
It all comes down to the margin spread. With expensive branded drugs, the manufacturer holds all the power.
Like the big pharma companies.
Right. So a distributor just gets a tiny fixed fee to move the box. But with generic drugs, there are dozens of manufacturers competing to sell the exact same pill.
Ah, I see.
So by teaming up with CVS through Red Oak, Cardinal Health created the single largest purchaser of generic drugs in the United States.
So they basically walk into a generic manufacturer's office and say, we represent the largest chunk of the U.S. market. Give us an astronomical discount, or you don't get shelf space at any CVS in the country.
That is exactly the conversation. They leverage that immense volume to drive their purchasing costs into the floor.
And then they capture a massive margin spread.
Yes, a spread that they get to keep as pure profit.
But here's what I don't get. If nobody ever switches distributors, right? And the core market is just this 3-lane highway where everyone is stuck in their lane and the toll to switch is too high, how does Cardinal Health show Wall Street any growth? I mean, they can't steal market share from McKesson or Cencora.
That realization is exactly what is driving their current strategy.
Okay.
The core distribution business is stable, reliable cash flow. But you're right, it is effectively frozen.
Right.
So to grow, they literally have no choice but to use that cash flow to buy their way into high-margin, specialized side businesses.
Which brings us to their growth strategy. Because they're projecting their specialty revenue will exceed $50 billion by fiscal year 2026.
It's a huge target.
And a big driver of this is their push into management services organizations, those MSOs. The Compascope research notes they are aggressively shifting toward equity-based physician alignment models.
Yeah, and this is a major strategic pivot.
How is it different from before?
Well, historically, a distributor would just sell supplies to a specialized clinic, say an independent gastroenterology practice.
Right, just drop off the supplies.
Exactly. But now, Cardinal Health is taking actual equity stakes in these clinics.
So they're essentially becoming the landlord of the practice.
Basically.
But why? I mean, if I'm Cardinal, why take on the operational headache of co-owning a doctor's office when I could just stick to selling them the bandages and the drugs?
It's about vertical integration.
Okay, explain that.
If you just sell them drugs, you capture a tiny distribution fee. But if you own a stake in the clinic, you take over their back office management.
Oh,
And you mandate that they buy all their highly profitable generic drugs and medical supplies exclusively through your core distribution network.
wow. So you force the volume.
Yes. Plus, you get a cut of the actual profits generated by the patient care. You lock the physician entirely into the Cardinal ecosystem.
They capture the profit at every single stage of the patient's journey.
Exactly. And they're applying a similar aggressive scaling logic to their at-home and nuclear divisions.
Right, those adjacencies.
Yeah. They're riding massive secular trends here. For example, they recently finalized the integration of a company called Advanced Diabetes Supply into their at-home network.
And what did that do for them?
That single acquisition instantly added 500,000 active patients to their home delivery roster.
500,000. That makes total sense, though, given how much care is shifting out of hospitals and into living rooms.
Definitely.
But, okay, you mentioned the nuclear division earlier, and I have to ask, what exactly are they doing with radioactive materials?
This is honestly their fastest growing, highest barrier niche. The division focuses on theranostics.
Theranostics. What is that?
These are specialized radioactive drugs that can both diagnose and treat specific cancers at a cellular level.
Oh, wow.
And Cardinal's nuclear division is currently seeing over 30% growth, heavily driven by their production of an isotope called actinium-225.
Okay, producing radioactive isotopes sounds like something out of a sci-fi movie. Why is a logistics company doing this?
Because the logistics are the primary barrier to entry.
Really?
Yeah, producing actinium-225 isn't like, mixing chemicals in a beaker. It requires access to nuclear cyclotrons and incredibly complex lead-lined handling facilities.
That sounds expensive.
It is. And here's the kicker. Radioactive isotopes decay.
Right.
Actinium-225 has a half-life of about 10 days.
Oh, wow. So from the second it's manufactured, a ticking clock starts.
Exactly. You can't put this in a normal warehouse and let it sit on a shelf for 6 months.
Of course not.
It has to be manufactured, specially packaged, and injected into a patient within days.
That's incredible.
So a new competitor cannot simply rent a delivery truck and start competing in this space. Cardinal has built a proprietary high-speed radioactive supply chain that supports over 15 clinical trials worldwide.
This is a brilliant defensive moat.
Brilliant, yes.
But waiting for these equity-based clinics to turn a profit or managing radioactive supply chains, that requires massive upfront capital and introduces a totally new set of execution risks, right?
Absolutely. It's not without risk.
So let's look at the vulnerabilities. Where does this ambitious growth plan fall apart?
Well, the most glaring vulnerability on their spreadsheet is customer concentration. We praised the CVS joint venture earlier, but that relationship is a double-edged sword. CVS accounts for roughly 30% of Cardinal Health's total global revenue.
30% from one customer. That sounds terrifying.
It is a huge number.
If CVS wakes up tomorrow and decides they're unhappy, do they just hold all the cards?
Well, it leans heavily toward a mutually assured destruction scenario, which ironically provides stability.
How so?
Because Red Oak is a 50-50 joint venture, they're structurally intertwined. CVS relies completely on Cardinal's massive scale to get the lowest possible prices on generics.
Right.
And Cardinal relies on CVS's thousands of retail locations to drive the volume that makes those low prices possible.
So if one walks away, both suffer a catastrophic collapse in their most profitable segment.
Yes, but the concentration risk doesn't stop there.
Oh, great. Who else?
Two major group purchasing organizations, Vizient and Premier, make up another 27% of Cardinal's revenue.
Okay, just so we're clear, group purchasing organizations, or GPOs, these are basically like a Sam's Club or Costco membership for hospitals?
That's a perfect analogy.
So they pool the buying power of hundreds of hospitals to negotiate cheaper supply prices.
Exactly. And because Vizient and Premier control so much volume, Cardinal has to bend over backwards to keep those contracts happy.
Because if a major GPO decides to steer its hospitals to a McKesson instead, Cardinal loses billions in revenue overnight.
Instantly, yes.
Now, what about the risks of becoming a part owner in all these specialty medical practices? The Confiscope report flagged a massive warning sign regarding a business called Navista.
Right. Navista is part of Cardinal's oncology MSO strategy. And recently, Cardinal had to take a $184 million goodwill impairment charge related to that business.
Okay, for those of us who don't read accounting textbooks for fun, what exactly does a goodwill impairment charge mean in plain English?
It essentially means they bought a business based on highly optimistic projections of its future profits, and now they have to publicly admit to their accountants in Wall Street that those future profits aren't actually going to materialize.
Ouch.
Yeah, they overpaid.
A $184 million miscalculation.
It proves that scaling this clinic ownership strategy won't be entirely frictionless.
Right.
The impairment showed that their initial transactional model for some of these oncology practices just wasn't yielding returns. It forced them to pivot harder into the equity-based models we discussed earlier.
So it's a learning curve.
Exactly. It's a clear signal that managing doctors is a lot harder than managing warehouses.
Makes sense. We also need to touch on the risks in that second division, the medical surgical products, GMPD.
Yeah, that business has much lower structural margins to begin with.
Why is that?
It's highly sensitive to raw material costs, like, the price of rubber for exam gloves, as well as global freight and fuel costs.
Right, physical goods moving across oceans.
Exactly. And they've also been hit hard by international tariffs on medical goods.
Plus, hanging over all of this like a dark cloud is the legal and regulatory overhang. Cardinal Health is still paying down their portion of a $5 billion opioid litigation settlement.
Right, which is spread out over 15 years.
15 years.
Yeah.
I mean, while a company generating this much cash can certainly manage those payments, it's a persistent multi-billion-dollar drag on their free cash flow.
It really is.
That is capital they cannot use to buy new clinics or invest in nuclear facilities.
Precisely. It's an opportunity cost.
So we understand the legacy moat, we see the aggressive pivot into higher margin specialty care, and we know the concentration and integration risks. Let's look at the actual scoreboard. Based on their Q3 2026 earnings call, who is winning the tug of war?
From a purely financial standpoint, Cardinal is winning decisively.
Yeah.
The Q3 numbers were incredibly strong. Total company revenue hit $61 billion for the quarter.
$61 billion in a single quarter.
Yeah, an 11% increase. And non-GAAP earnings per share jumped 35% to $3.17.
Wow.
They even felt confident enough to raise their full-year earnings guidance and bumped their adjusted free cash flow projections to between $3.3 billion and $3.7 billion.
Those are staggering numbers. But, when I was reading through the earnings transcript, there was a fascinating accounting dynamic happening regarding GLP-1 weight loss drugs and the Inflation Reduction Act, the IRA.
Yes, it is a brilliant case study in how complex pharmaceutical accounting can be.
Break it down for us.
On the call, management noted that GLP-1 drugs added 6 full percentage points to their revenue growth.
Which is huge.
It is. However, that was almost entirely wiped out by a 6 percentage point hit to revenue caused by IRA-mandated list price reductions.
Okay, let's map out the dollar flow on that, because if you've watched the news lately, you've seen the absolute frenzy around weight loss drugs like Ozempic or Wegovy.
Oh, absolutely.
And you would assume that moving millions of boxes of highly demanded, expensive drugs would make Cardinal Health incredibly rich. But management referred to GLP-1s as empty calories for profit. Why?
Because we have to separate revenue from actual profit.
Okay.
Remember, Cardinal Health is a distributor. Their margin on a branded drug is essentially a flat fee for the physical act of moving the box from point A to point B.
So if the drug costs $100 or $1,000, Cardinal's fee for putting it on the truck might still just be a couple of bucks.
Exactly. But on their financial statements, Cardinal records the total wholesale acquisition cost the sticker price of the drug as top-line revenue when it moves through their system.
Oh, I see.
So GLP-1s are incredibly expensive and moving in massive volumes, so Cardinal's top-line revenue skyrockets.
But the profit doesn't.
Right. Their actual profit margin on those specific drugs is razor thin, hence empty calories. Great for the revenue vanity metric, but meaningless for the bottom line.
And how does the Inflation Reduction Act interact with that?
So, under the IRA, the government is mechanically forcing down the wholesale acquisition cost, or sticker price, of certain high-use drugs. We're just looking at the policy mechanism here.
Right.
So, if the government forces the sticker price of a drug down by 10%, Cardinal's top-line revenue for moving that drug shrinks by 10%.
Yeah.
That is the 6% hit they reported.
Okay, so if the sticker price drops, I would assume Cardinal's profits take a massive hit too. Is that what happened?
That's the logical assumption, but it's actually completely wrong.
Really?
Because Cardinal just charges a flat fee for the physical service of distribution, their actual cash profit doesn't move a millimeter.
Oh, interesting.
They simply renegotiate their contracts with the drug manufacturers to ensure their fee-for-service economics remain identical, regardless of what the government dictates the final sticker price should be.
So the top-line revenue looks smaller on the earnings report, but the actual cash they put in the bank stays perfectly steady.
Precisely. It is entirely an optical issue on the revenue line, not a fundamental threat to their profitability.
That is fascinating. What else stood out in their Q3 performance?
Their operational resilience was deeply impressive. Despite severe winter storms sweeping across the country during the quarter, they maintained record-high service levels.
Which is critical for hospitals.
Right. Ripping out their IT systems is hard, but proving they can reliably deliver life-saving supplies during a blizzard reinforces exactly why hospitals refuse to switch distributors.
They also seem to be executing well on those high-growth adjacencies we talked about.
Very well. The distribution volumes for their new Solaris MSO are actively ramping up.
Showing the strategy works.
Exactly. Proving the vertical integration strategy is generating the expected throughput.
All right, as we pull all of these threads together, for you listening and trying to figure out where Cardinal Health goes from here, what are the specific keys to watch?
Good question.
If you want to predict their future success, what metrics should you be tracking over the next few quarters?
First, monitor the regulatory pricing nuances. We just explained how Cardinal neutralizes the IRA list price reduction.
Right.
But what you really need to watch is if the government eventually moves toward capping or standardizing the actual distribution service fees. If regulators dictate how much a middleman can charge to move a box, that fundamentally alters the compensation model for the entire industry.
That would be a direct strike on their core profits.
Yeah.
What about the medical surgical division? You mentioned tariffs earlier.
Watch the IEPA tariff refund. Cardinal has paid roughly $200 million in these specific medical goods tariffs.
Okay.
Recently, the Supreme Court ruled the mechanism for those tariffs was unlawful. If a refund process actually materializes, Cardinal expects they would keep about half of it.
So around $100 million.
Right, after passing the rest back to their customers. That would be a sudden, massive injection of pure earnings, though the timing is completely unknown.
And obviously you have to watch contract renewals given that heavy concentration with CVS and the big hospital purchasing groups.
Yeah.
But what about the clinical side?
Keep a very close eye on biosimilars.
Explain how a biosimilar fits into this.
A biosimilar is essentially a generic version of a highly complex biological specialty drug.
Okay.
And just like standard generic pills, biosimilars offer vastly wider profit margins for distributors than branded drugs do.
So it's the Red Oak strategy again?
Exactly. The faster biosimilars penetrate the market and get prescribed by doctors, the stronger Cardinal's profit pool becomes through their Red Oak joint venture.
Okay, if I force you to pick just one thing, out of all of these complex factors, the tariffs, the IRA, the CVS, contracts what is the single most important metric for Cardinal Health's future.
Without a doubt, it is the performance of the higher growth adjacencies, the nuclear theranostics and the at-home solutions.
Why are those the ultimate deciding factor?
Because the core drug distribution business is a slow-growing oligopoly. It generates a mountain of cash, but it will not change the trajectory of the company.
It's just funding the next phase.
Right. The entire investment thesis relies on their ability to capture the future of healthcare, which is highly personalized nuclear medicine and decentralized home-based care. If those divisions stumble, Cardinal Health falls back to being a highly efficient but low-margin delivery service. If they succeed, they evolve into something completely new.
So we've seen how Cardinal Health is using the immense, reliable cash flow generated by its negative cash conversion cycle to fund a radical transformation.
Yeah.
They're defending their legacy mode by being too complex to rip out, while aggressively buying their way into the highest margin, most specialized verticals in medicine.
It is a masterclass in leveraging structural lock-in to fund an offensive pivot.
It really is. Which leaves me with one final thought for you to ponder.
Ooh.
As healthcare continues its massive shift away from giant centralized hospitals, moving instead into hyperlocal specialty clinics and directly into patients' living rooms, will the word distributor even accurately describe Cardinal Health in 10 years?
That's a good point.
If they own the clinic, supply the proprietary drugs, and manage the home care network, are they secretly using their plumbing infrastructure to build an entirely new kind of decentralized healthcare provider?
It's a compelling question. The lines between delivering the medicine and delivering the care are blurring very quickly.
They really are. Well, thank you for joining us on this deep dive. The next time you pick up a prescription, take a second to think about the incredible complexity of the invisible pipes that got it there. Keep exploring, keep questioning, and we'll catch you on the next one.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.